Definition of trading: understanding the features and benefits. Option trading is a type of trading strategy that involves buying and selling options contracts on an underlying asset, such as stocks, commodities, or currencies. Options are financial contracts that give the buyer the right, but not the obligation, to buy or sell an underlying asset at a predetermined price, known as the strike price, on or before a specific date, known as the expiration date. Suppose an investor is interested in buying shares of XYZ company, which is currently trading at $50 per share. However, the investor is unsure whether the price will increase or decrease in the next month, so they decide to use options to manage their risk. The investor buys a call option contract on XYZ company with a strike price of $55 and an expiration date in 1 month. The premium for the option contract is $2 per share, or $200 total, since each option contract typically represents 100 shares. If the price of XYZ company's stock increases to $60 per share by the expiration date, the investor can exercise the option and buy the shares at the lower strike price of $55, resulting in a profit of $3 per share, $60 stock price minus $55 strike price minus $2 premium paid. The total profit for the investor would be $300, $3 profit per share x 100 shares per contract. Call options. A call option gives the buyer the right, but not the obligation, to buy the underlying asset at a predetermined price, known as the strike price, on or before a specific date, known as the expiration date. A call option is profitable if the underlying asset's market price rises above the strike price, allowing the buyer to purchase the asset at a lower price and sell it at a higher price. Put options. A put option gives the buyer the right, but not the obligation, to sell the underlying asset at a predetermined price, known as the strike price, on or before a specific date, known as the expiration date. A put option is profitable if the underlying asset's market price falls below the strike price, allowing the buyer to sell the asset at a higher price than its market value. In the money and out of the money are terms used to describe the relationship between the current market price of the underlying asset and the strike price of an option contract. In the money, a call option is considered in the money when the market price of the underlying asset is above the strike price of the option. Similarly, a put option is considered in the money when the market price of the underlying asset is below the strike price of the option. In other words, exercising the option would result in a profit. Out of the money. A call option is considered out of the money when the market price of the underlying asset is below the strike price of the option. Similarly, a put option is considered out of the money when the market price of the underlying asset is above the strike price of the option. In this case, exercising the option would not result in a profit. For example, suppose you buy a call option with a strike price of $100 and the current market price of the underlying asset is $110. In this case, the call option is considered in the money because the market price is higher than the strike price. If you were to exercise the option, you could buy the underlying asset at $100 and immediately sell it in the market for $110, resulting in a profit. On the other hand, if the market price of the underlying asset was $90, the call option would be considered out of the money because exercising the option would result in a loss. In this case, it would be more profitable to buy the asset directly from the market instead of exercising the option. The strike price and premium are both important terms in options trading, but they represent different concepts. The strike price is the price at which the underlying asset can be bought or sold when the option is exercised. It is fixed when the option is created and does not change during the life of the contract. For call options, the strike price is the price at which the underlying asset can be purchased, and for put options, the strike price is the price at which the underlying asset can be sold. The premium, on the other hand, is the price that the buyer of an option pays to the seller for the right to buy or sell the underlying asset at the strike price. It represents the cost of the option and is determined by a number of factors, including the current market price of the underlying asset, the time remaining until expiration, the volatility of the underlying asset, and the current interest rates. Example: call option on XYZ stock with a strike price of $50 and a premium of $2. If the holder of the call option chooses to exercise it, they can buy XYZ stock at $50 per share, regardless of its current market price. However, the holder of the call option paid a premium of $2 for this right. Therefore, the break-even point for the holder of the option is $52, $50 strike price plus $2 premium, meaning that the stock needs to be trading at or above $52 for the option to be profitable. The option writer is the seller of an option contract. They receive a premium payment from the option buyer in exchange for taking on the obligation to sell or buy the underlying asset at the strike price, if the option buyer chooses to exercise the option. For example, if an investor sells a call option, they are obligated to sell the underlying asset at the strike price if the option buyer chooses to exercise the option. The option buyer is the purchaser of an option contract. They pay the premium to the option writer in exchange for the right, but not the obligation, to buy or sell the underlying asset at the strike price before or at the expiration date of the contract. For example, if an investor buys a call option, they have the right to buy the underlying asset at the strike price if they choose to exercise the option. What is difference in option trading and future contract? Why investor invest in option trading? Both options trading and futures trading are popular derivatives instruments used by investors to manage risk and generate profits. However, there are some key differences between the two, which may make options trading more suitable for certain investors. One key difference is that options provide the buyer with the right, but not the obligation, to buy or sell the underlying asset at a specific price, strike price, before or at expiration. Futures, on the other hand, obligate both parties to buy or sell the underlying asset at a specific price and date in the future, regardless of whether it is profitable. This means that options provide more flexibility and control over the underlying asset compared to futures. For example, if an investor buys a call option, they can choose not to exercise the option if it is not profitable. However, if the investor buys a futures contract, they are obligated to buy the underlying asset at the specified price and date, even if the market price is lower. The main difference between European options and American options is the exercise feature. European options can only be exercised on the expiration date, while American options can be exercised at any time before the expiration date.